Welcome back to the Deep Dive. Look, this isn't just another chat. This is, frankly, essential listening. For years, maybe decades, we've all sort of taken the US dollar's stability for granted. But things are changing. We've got this massive national debt piling up, and then there's the whole rise of digital assets, Bitcoin, crypto in general. It's forcing a global reckoning. The question isn't if the financial world is changing anymore, it's how fast. And maybe more importantly for you, what should you be doing about it?
Exactly. We're diving right into the heart of what some are calling the Great Currency War. Today, we've pulled together a lot of complex data, sometimes data that even seems to conflict. It's from places like the CFA Institute, Morgan Stanley, the Fed, core crypto security researchers too. Our mission here isn't to create hype. It's to give you a clear analytical roadmap. We're going to dissect the strongest arguments from both sides. You've got the bulls who see Bitcoin as maybe an escape from government financial instability.
Right, the digital gold argument.
Precisely. And then you have the bears who are sounding the alarm about, well, extreme volatility in digital assets, potential scams, regulatory crackdown.
Yeah, a very different picture. So our goal for you, the listener, is straightforward. We want to equip you with the knowledge, the framework, to build your own essential playbook for what's coming. Stick with us here at KaiZen right to the very end. You'll walk away knowing concrete steps you can take, like right now, to protect your assets, maybe even position them for growth. Doesn't matter if the US dollar stays king or if digital currencies really do usher in a totally new era, you need a plan.
Okay, we've got some pretty complex financial ideas coming up, so let's make sure everyone's locked in. If you appreciate this kind of deep dive, this level of analysis, just take a quick second right now and hit that like button. Seriously. It helps make sure this vital info keeps reaching the people who really need it. All right, let's start with the current champion, the US dollar. I mean, by almost any measure you look at, it's still incredibly dominant. Think about it, involved in something like 88% of all international transactions, and nearly 60% of the world's foreign exchange reserves held in USD.
That's huge. That dominance gives the U.S. incredible economic leverage, right?
Absolutely unique power. But, and this is a big but, based on the sources we reviewed, getting complacent would be dangerous. The foundations of the buck, as many call it, they are showing visible signs of erosion.
And the number one reason people point to, the biggest crack in that foundation, seems to be fiscal unsustainability, or as you called it earlier, the debt monster. This isn't really a partisan talking point. It's showing up in serious financial analysis. We looked at a survey of CFA Institute members worldwide. These are some of the sharpest financial minds out there. And get this, a huge supermajority, 77%, believe U.S. government finances are just not sustainable on the current path.
Not sustainable. And that number is actually even a bit higher if you look just at developed markets. There's deep pessimism there. But to really grasp the seriousness, we need to look at the numbers and, maybe more importantly, the timeline. Economists over at the Penn Wharton budget model, they're known for really rigorous long-term projections. They didn't pull any punches. They estimate that based on current spending, current deficit trends, financial markets probably can't sustain more than 20 additional years of deficits.
40 years?
Before the United States faces a potentially devastating and irreversible default.
Wow. Okay, 20 years might sound like a decent chunk of time to some people listening, but in terms of global finance, that's like right around the corner. It means that basically everyone, governments, companies, individuals like you listening, you have to start factoring the potential end date of America's current fiscal model into your long-term plans now.
Precisely. And that explains why, in that same CFA survey, 61% of these professionals believe the U.S. will be fundamentally unable to actually reduce its high debt-to-GDP ratio, or even just contain the deficit spending. The political will, or maybe the mechanism, just isn't seen as being there.
And this debt-to-GDP ratio, just to put it in perspective.
Yeah, let's contextualize that. The current ratio, the federal debt held by the public compared to our annual economic output, it's already close to the incredibly high levels we saw right at the end of World War II.
Okay, but during WWII, the U.S. was, all in on an existential fight. The economy was mobilized, and the debt was paid down pretty fast afterward during the post-war boom.
Exactly. That's the critical difference. Today, we're operating under a similar level of financial stress, but without that wartime economic footing, and crucially, without any clear, politically viable way to pull back from the edge.
So this unsustainable debt, it directly fuels the second big threat you mentioned. which is
De-dollarization. And this is where geopolitics really enters the picture. Think about it. If the U.S. financial system itself is under fundamental stress, doesn't that increase the incentive for Washington to, well, use the dollar as a weapon? It creates significant sanctions risk for other countries.
And we saw that happen pretty starkly, didn't we?
We absolutely did. The freezing of Russia's foreign exchange reserves after the 2022 invasion of Ukraine. That action sent a frankly chilling message across the globe. The message was, if you rely heavily on the USD, you are implicitly accepting the political jurisdiction of the U.S. Treasury and its allies.
So for countries playing complex geopolitical games or
Right.
just wanting stability in trade,
It increases the salience of sanctions risk, as the analysts put it. It makes de-risking from the dollar, moving away from it, not just an economic choice, but a geopolitical necessity.
and we're seeing this play out in actual trade agreements.
Yeah, definitely. You see countries like Saudi Arabia, India actively exploring alternatives. It's not always because they dislike the dollar's functionality, but they need to manage geopolitical risk. They're trying to reduce how much they use the USD in trade invoicing, just to insulate themselves from potential future sanctions or political fallouts.
Okay, so if the world is looking for an escape hatch from the dollar, where are they actually going? Is there a clear successor?
Well, that's the interesting part. The research suggests the alternative probably isn't a single replacement currency. Only about 6% of the financial professionals we surveyed picked the Chinese renminbi as the most likely candidate to displace the dollar.
Despite China's massive economy.
Right, and that reflects the reality that, yes, China's a huge trading power, but its currency operates under strict capital controls. It lacks that open, transparent legal framework that's really necessary for deep global trust. The dollar system, for all its flaws, has had.
Okay, so unpack the consensus prediction then. What do most experts think will happen?
Right, this is where you see the global market mindset. A large majority, about 63%, believe the USD is going to lose its prominent reserve status over the next, say, 5 to 15 years. Now, about 51% expect that to be a marginal loss, sort of a gradual chipping away at its dominance.
But the other part.
But 12% expect a material loss, and that would fundamentally shake the entire global financial system.
So if it's not one currency, what's the alternative they see?
The preferred alternative, chosen by 38% of these experts, is a multipolar currency system. Think of it less like one king being replaced and more like a shift to regional powers. Regional blocs using currencies like the euro, maybe the yen, or potentially new digital currencies for their own trade. This just lessens the global need for the dollar as the go-between for everything.
And after the multipolar idea.
Following that, interestingly, tied at 12% each were two options: a digital currency or a return to a hard currency like gold.
So that tells you something right there. High-level financial professionals are already viewing digital assets as a serious, plausible contender to potentially displace some of the dollar's reserve role. And beyond these big long-term shifts, there are immediate pressures on the dollar too, right?
Yeah.
Things happening right now.
Oh, absolutely. Analysts, for instance, at Morgan Stanley, they point out that even while the Federal Reserve is aiming for that nice, stable 2% average inflation, you've got other factors pushing down on the dollar's value. Things like uncertainty around future policy, weaknesses in the labor market. These create immediate headwinds, feeding into that longer-term instability story.
And trade policy plays a role too, tariffs and things like that.
A huge disruptive role. You might remember the U.S. economy saw this historic surge in imports back in the first quarter of 2025, like a massive 43% annualized rate spike.
Why did that happen?
Well, the data suggests it was largely U.S. businesses basically pulling forward their purchases. They were stocking up before expected increases in tariffs and other trade barriers kicked in. And that kind of behavior, trying to front-run government policy, it signals deep uncertainty. It injects volatility. And that really undermines the dollar's core promise, which is reliability in global trade.
Okay, so that paints a pretty concerning picture for the traditional system. And this is where the bull case for Bitcoin really starts to emerge, almost directly from the bear case for the buck, right? If the US dollar's long-term stability is genuinely in question because of debt, because of geopolitical weaponization, then the world logically starts looking for something else, something truly sovereign, politically neutral. And this is where Bitcoin's core idea, censorship resistance, really comes into play.
That's exactly the argument. The fundamental case for Bitcoin really hinges on its design. It's a peer-to-peer electronic cash system. And the revolutionary part is that it allows transactions without needing intermediaries. No central banks, no governments, no big financial institutions in the middle. This inherent structure makes it resistant to third-party manipulation. Plus, There's transparency because every single transaction gets recorded on that public, verifiable ledger, the blockchain.
Let's dig into the security aspect a bit more, because I think that's something people hear about but maybe don't fully grasp. How is it actually secured?
Right, it's crucial. The system is secured by this global network of computers. They're called nodes, and these nodes constantly enforce the network's rules, their most critical job. They will not accept an invalid transaction as payment, period. That means someone trying to attack the network can't just create money out of thin air. They can't spend Bitcoin that never belonged to them in the first place. It's like a financial firewall built right into the code's consensus rules.
And that consensus relies on something called proof of work.
Yes, and this leads to the integrity mechanism. That verification process confirming transactions, it's only reliable as long as honest nodes control the majority of the network's computing power, or hashing power.
Hmm.
And the system preserves this integrity by deliberately making that verification process a costly business. It's not free to validate transactions.
Yeah.
Miners have to spend significant resources. We're talking expensive, specialized computer hardware and a lot of electrical power just to validate blocks of transactions.
So the cost itself is the security feature.
In a way, yes. This economic cost secures the network. It means that for an attacker to successfully rewrite the transaction history on the blockchain, they'd have to spend an enormous amount of money on equipment and energy constantly. It would be incredibly expensive and visible. That cost makes large-scale fraud economically prohibitive. And that is the core economic theory underpinning Bitcoin's claim as a potentially trustworthy store of value.
Okay, so that's the technical foundation. But here's where it gets really interesting for people actually managing money, whether it's a big fund or just your own savings. The inflation hedge argument. For ages, investors have turned to things like gold, right? Hard assets to protect their purchasing power when governments print too much money or inflation spikes. Now, studies are suggesting Bitcoin might act in a similar way, that it behaves similarly to gold and also reacts to interest rates, showing statistically an increase in its returns right after unexpected inflation shocks.
That's right. And those shocks, they're typically measured by surprises in economic data releases, like the Consumer Price Index, the CPI announcements. When inflation comes in hotter than expected, traditional assets often take a hit. But this research indicates Bitcoin can actually react positively in those moments. Empirically, it aligns it with the role of an inflation hedge. It acts like a decentralized store of value precisely when confidence in fiat currency, like the dollar, is shaken by unexpected monetary expansion.
Okay, but we need to add a note of caution there, right? It's not always a perfect hedge.
That's a very important nuance, yes. While it has shown these hedging properties, some analysis suggests that this quality might actually be diminishing over time.
Why would that be?
Well, think about it. As Bitcoin matures, as it gets adopted more widely by institutions and individuals, it starts to behave a bit more like other traditional high-risk assets. Its correlation with the stock market, for example, has increased. So the more mainstream it becomes, potentially, the more its unique non-correlation benefit might fade. It could lead to higher overall volatility, but maybe less distinct hedging power compared to, say, 5 or 10 years ago. It's evolving. It's shifting from this niche anti-system bet into more of a global macroeconomic asset itself.
Interesting. But for the true bull investor, the focus right now is probably less on hedging and more on timing these massive cycles, right? The whole going to the moon narrative.
Yeah. Yes, the cycles. And a lot of that analysis centers around the Bitcoin halving events. The halving, which happens roughly every 4 years, programmatically cuts the rate at which new Bitcoin are created and enter the market. It literally halves the new supply. This acts as a really fundamental indicator for potential trend changes because it creates an immediate, predictable supply shock against whatever the current demand is. Historically, these events have been followed by significant price increases.
And technical analysis tools actually pick up on this pattern.
They do. Tools that traders use to gauge market momentum consistently seem to detect the shift. Take the MACD, for example, that stands for Moving Average Convergence Divergence. It's basically an indicator that shows the relationship between two different moving averages of Bitcoin's price, helping to spot trends.
Then what does the MACD show around the halvings?
Well, specifically, analysts look for something called a golden cross. That's a signal where the shorter-term moving average crosses above the longer-term moving average. This golden cross is pretty consistently detected sometime after each halving event. And it's seen as a sign of strong, short-term bullish momentum starting to overpower the longer-term trend. Historically, that signal has often preceded the most powerful phase of the bull run that follows. It's the technical reflection of that supply shock hitting steady or growing demand.
Okay, so bringing it to the present. We had the most recent halving, the fourth halving, back in April 2024. Based on this historical cycle analysis, what's the projection? When might this cycle peak?
Right. So if you look at the average length of the bull runs after the previous halvings, the analysis suggests the peak price in this current cycle might occur approximately 483 days after that April 2024 event.
483 days.
Yeah.
But crunching the numbers, that puts the potential peak somewhere around.
Around September 2025. Give or take, placing it squarely in the third or maybe fourth quarter of 2025. Now, obviously, past performance is no guarantee, but this provides a potential time frame derived from historical patterns, linking the fundamental supply economics of the halving to technical market indicators. It's a key window for investors thinking about strategy.
Okay, that brings us directly to you listening right now. You're the informed investor here. We've laid out the argument for maybe holding a decentralized asset when fiat currencies look shaky. So let's do a quick check-in. If you currently own crypto, maybe you believe in that September 2025 timeline, you are holding strong through the ups and downs, take a second right now, find the comments, and just type HODL. Let us know you're sticking with it. On the other hand, if you're feeling nervous, if the volatility, the risks we're about to get into have you thinking maybe it's time to sell, type as L. Let's see where the KaiZen audience stands. Are you a brave investor ready for this next phase? Tell us in the comments.
All right, well, that bull case, especially framed against the U.S. debt situation, sounds compelling. We absolutely have to slam on the brakes and deliver a serious reality check. The bear's roar is loud for a reason. It's grounded in, well, decades of financial history and some really painful, sometimes catastrophic failures, specifically within the crypto world itself. Let's start with risk number one. Just the sheer extreme volatility and the constant specter of speculative bubbles.
Yeah, the price swings can be absolutely wild. It's not just a little bit volatile. It's on a whole different level sometimes.
It's fundamental to these assets right now. Bitcoin, many other digital assets, they're characterized by a staggering standard deviation of returns. That's the statistical measure of volatility. What it means in plain English is the daily, even weekly, price swings are so enormous, they make the ups and downs of the traditional stock market or bond market look almost calm, almost sleepy by comparison. And that makes managing a portfolio with crypto incredibly difficult and, frankly, pretty nerve-wracking for the average person.
And this is why skeptics keep bringing up historical comparisons, right? Like the tulip mania.
Exactly. Skeptics often reach for those parallels. You mentioned tulip mania from 1637, where tulip bulb prices went astronomical and then crashed to basically nothing. Or more recently, the dot-com bubble around 1999-2000, where internet stocks hit valuations that made no sense, then imploded. You have very respected investors like Howard Marks from Oaktree Capital, who back in 2017 explicitly called digital currencies nothing but an unfounded fad, or perhaps even a pyramid scheme. He put them right in that same category as those historical manias.
That's a heavy comparison. The implication is that it's all just driven by hype and speculation.
The argument is that financial manias happen over and over again because of basic human emotions. Greed, and maybe even more powerfully, the fear of missing out, FOMO. Skeptics look at Bitcoin's price chart over the years, these huge run-ups followed by dramatic crashes, and they say, look, that pattern is identical to historical bubbles. The big question for you as an investor is, has Bitcoin actually matured beyond being just a speculative frenzy, or are these cycles just history repeating itself again?
Okay, so beyond the risk of just being in a bubble, there are more tangible risks too, things actually going wrong. Fraud, scams.
Oh, yes. Tangible execution risks.
Yep.
And the history of crypto is absolutely littered with cautionary tales of people losing massive amounts of money. We've seen huge headline-grabbing thefts, hackers stealing $31 million from Tether in one go, a staggering $530 million stolen from the Coincheck exchange in Japan. These hacks highlight a key vulnerability. Centralized exchanges are honeypots.
And it's not just hacks, right? Exchanges themselves can just collapse.
Perhaps even more devastating than the hacks are the exchange failures. We all remember Mt. Gox from years ago, but bankruptcy filings have continued to plague the industry. And when a centralized exchange goes bankrupt, the user funds held on that exchange are often treated as the company's own assets in the bankruptcy process. That means you, the user, might end up as just an unsecured creditor, potentially waiting years to maybe recover only a tiny fraction of what you held there. It's brutal.
And all this chaos has obviously drawn the attention of regulators.
intense attention. And it's forced regulators like the SEC in the US to take pretty significant enforcement actions, especially recently, like in 2024. They've gone after big established players, Coinbase, Kraken, Binance, often alleging unauthorized activities. The general regulatory view seems to be that a lot of what happens in the crypto market, especially the trading of many different tokens, looks an awful lot like traditional securities trading. And if it looks like securities trading, it needs the same kind of investor protections, which the crypto market has often, let's say, resisted.
Okay, but what if you try to avoid those centralized exchanges? What if you go fully decentralized? Does that solve the risk problem?
Not entirely. Decentralization avoids the single point of failure of an exchange, but it introduces its own unique set of technical security vulnerabilities. The most famous one people talk about is the 51% attack. We mentioned earlier that the network's security relies on honest nodes controlling most of the computing power. The theoretical threat is, what if a single entity, a bad actor, manages to gain control of more than half 51% of the entire network's hashing power?
What could they do then? Could they steal everyone's Bitcoin?
That's a common misconception. It's crucial to understand the limits here. Even with 51% control, an attacker cannot just steal money from wallets that aren't theirs. They can't create new Bitcoin out of thin air either. The core protocol rules prevent that. What they can potentially do is try to reverse their own recent transactions. It's called a double spend. They could try to spend some Bitcoin, then use their majority power to rewrite the blockchain history slightly to make it look like that transaction never happened, allowing them to spend the same coins again. While they can't steal directly from others, the ability to reverse transactions, even their own, severely undermines the network's integrity. It damages the trust that is Bitcoin's core value proposition.
Okay, so that's a network-level threat. What about threats aimed more at individual users?
Right, there are privacy threats designed to compromise the user, not the network itself. We're seeing an increase in things like dusting attacks. This is a subtle technique. Attackers send tiny, almost worthless amounts of crypto called dust to thousands, maybe millions of different wallet addresses. Then they watch carefully where that dust moves. By tracking how those tiny amounts get combined with other funds in subsequent transactions, they try to link multiple addresses together. The goal is to figure out which addresses likely belong to the same person or entity.
And why is linking addresses dangerous?
If the attacker can successfully link several addresses and realize they all belong to one owner who holds a significant amount of crypto, that owner suddenly becomes a very specific target. They become vulnerable to highly targeted phishing attacks, ransom demands, or in extreme cases, even physical threats or extortion. It's basically a way to try and strip away the anonymity and identify high-value targets.
Wow. Okay, one more technical threat, especially relevant in the DeFi space, decentralized finance.
Yes, Oracle manipulation. This is a big one in DeFi. See, DeFi applications often rely on smart contracts that need real-world data, like the current price of Ethereum in US dollars, to function correctly. Oracles are the services that feed this external off-chain data onto the blockchain so the smart contracts can use it. The vulnerability is, what if the data the Oracle feeds in is wrong or deliberately manipulated? The smart contract will then execute based on bad information, potentially leading to huge financial losses for users.
How could someone manipulate an oracle?
A common method involves using something called flash loans. These are a unique DeFi tool where an attacker can borrow a massive amount of capital, sometimes hundreds of millions of dollars, with zero collateral, but only if they pay it back within the very same transaction block, which is usually just seconds. The attacker takes this huge temporary loan and uses it to flood one side of a decentralized exchange, artificially pumping or dumping the price of an asset for just a moment. The Oracle, doing its job, reads this fake, manipulated price off the exchange and feeds it to other DeFi protocols. Those protocols then might trigger incorrect liquidations or unfair trades based on the bad price data. Then the attacker repays the flash loan, the price snaps back to normal, but the damage in those other protocols is already done. It's like a temporary, targeted distortion of market reality.
Okay, that's quite a list of risks, from market bubbles to sophisticated hacks. So given all that, what's the practical advice? What can someone listening actually do to defend themselves?
Look, at the end of the day, especially for individual users, security largely boils down to two things: user education and adopting robust physical security practices. Since many attacks, particularly phishing scams, are just standard internet fraud techniques applied to crypto, basic cybersecurity hygiene is paramount. Always double-check the URL of any exchange or wallet website you visit, use strong, unique passwords, and enable two-factor authentication, 2FA, absolutely everywhere you possibly can.
And for storing larger amounts,
Definitely.
keeping it off the exchanges.
For any significant amount of crypto, the only reasonably safe approach is cold storage. That means getting your assets completely off the internet, off the exchanges, and onto wallets that are not connected to the network. This usually involves specialized hardware wallets. They look like little USB drives. The private keys, the things that actually control your crypto, should be generated and stored entirely offline on these devices. And just as importantly, any backups you make of those private keys, the recovery phrase or seed phrase, must also be made and stored offline. Think durable methods like writing them down on paper, maybe engraving them on metal plates, stored securely. Ideally, you want geographic redundancy too. Store backups in multiple, physically separate, safe locations. That way, a single disaster like a fire or theft can't wipe out your access to your entire crypto holdings.
We've talked a lot about the inherent risks in crypto itself, but another huge layer of risk, or maybe potential stability, comes from regulators trying to get their arms around this whole thing. And right now, the regulatory landscape looks incredibly messy, right? It's completely fragmented across the globe.
Oh, absolutely fragmented. It's a major headache for any crypto company trying to operate internationally. Our sources highlight this stark variation. You've got, I think, 9 countries currently maintaining an absolute ban on cryptocurrencies, China being the most significant example there. And then another 39 countries have what's called an implicit ban, usually through things like severe banking restrictions or heavy penalties that make operating practically impossible.
The other places are moving in the opposite direction, trying to create clear rules.
Exactly. Contrast that crackdown with regions that are moving pretty aggressively to actually establish a formal legal framework. The European Union is arguably leading the tack here with its markets and crypto assets regulation, usually just called MiCA. MiCA is a really comprehensive, specifically designed pan-EU system. The goal is to harmonize the rules for crypto across all the EU member states.
And what does MiCA actually cover?
It's quite broad. It specifically addresses stablecoins, and it even divides them into different categories. You have asset reference tokens, ARTs, which are backed by a mix of assets, and electronic money tokens, EMTs, typically backed one-to-one by a single fiat currency, like a euro stablecoin. It also covers utility tokens. This whole framework officially came into force in mid-2024, aiming to bring regulatory clarity and consumer protection to the issuance and operation of these assets. Companies do have a transition period, though, until mid-2026 to get fully compliant.
So Europe is trying to build guardrails, and then there's the outlier, El Salvador.
Right, we have to mention El Salvador, a completely different approach. In June 2021, they made that incredibly bold move, becoming the first country in the world to adopt Bitcoin as actual legal tender. This means Bitcoin is legally interchangeable with the US dollar, which El Salvador also uses. Merchants there are technically required to accept Bitcoin if they have the means to do so. It was a radical embrace of the decentralization idea at a national sovereign level.
But the really big player, the one everyone watches, is the United States. What's the mood there? It seems like it's been shifting.
Definitely shifting. There's been a noticeable pivot in U.S. policy recently. It seems driven partly by market pressure, partly by a growing political awareness that the U.S. risks falling behind in this area. The newer aim appears to be positioning the country as a potential leader in digital asset innovation, and that involves actively supporting the industry's growth and, really crucially, working to make it easier for legitimate crypto companies to get access to banking services. That's a huge change from the past environment where most banks wouldn't touch crypto with a 10-foot pole.
So the institutions are getting involved, and the regulators are trying to figure out how to handle it. We're seeing actual legislation now.
Yes, the institutionalization is happening. And the first really major piece of federal crypto legislation that actually got enacted in the U.S. is the Genius Act. This one specifically targets payment stablecoins, setting up a comprehensive framework for them. And this is where the bull case for stablecoins as efficient payment rails kind of crashes into the reality of regulatory control, the bear case, if you will.
How so? What does the Genius Act require?
It imposes some pretty strict rules. Issuers of these permitted stablecoins, called PPSIs, they have to register. Significantly, they have to hold their reserves, the assets backing the stablecoins, within the United States. But probably the most revealing requirement, the one that really challenges that original crypto ethos of censorship resistance, is this. Issuers must comply with legal orders to seize, freeze, or even burn stablecoins.
Wow. Seize, freeze, or burn.
Ah.
So if law enforcement comes with a court order,
They have to comply. And this fundamentally changes the nature of those stablecoins, at least the ones operating under this U.S. law. They shift from being potentially decentralized, borderless digital cash into becoming regulated instruments, much closer to money in a regulated bank account. If the government can order your assets frozen or seized, that whole censorship resistance argument goes out the window, at least for these specific regulated stablecoins.
Yeah.
It's basically the government ensuring that digital dollars remain firmly under sovereign control.
Okay, so that's stablecoins getting regulated. What about the rest of crypto? Bitcoin, Ethereum, all the other tokens. There's still this big fight over whether they're commodities or securities, right?
That struggle over jurisdiction is absolutely ongoing in Congress. The big goal is to get clarity on the market structure. Who regulates what? The House, for instance, passed a bill called FIT21. It tried to draw a line. It proposed giving the CFTC, the Commodity Futures Trading Commission, primary authority over things deemed digital commodities, typically assets seen as more decentralized, like Bitcoin. And it would leave the SEC, the Securities and Exchange Commission, with authority over things classified as restricted digital assets, essentially those deemed to be securities.
But the SEC wasn't happy with that proposal.
Not at all. The SEC pushed back hard, particularly against the part of FIT21 that allowed companies to largely self-classify their tokens initially. Their main arguments were about resources and consumer protection. They basically said, look, we'll be completely overwhelmed trying to review potentially thousands of these self-certifications. We don't have the staff to properly challenge them if we disagree. And their fear was this would create huge gaps, leaving potentially millions of investors exposed to trading what are essentially unregistered securities without proper disclosures or protections. So that friction point between the agencies is a major factor slowing down comprehensive U.S. regulation.
But even with all this regulatory uncertainty and infighting, big traditional finance players aren't just sitting on the sidelines, are they?
Not at all. Financial integration is happening regardless. You're seeing major institutions, not just crypto startups, actively building with this technology. JP Morgan Chase is a prime example. They've been deeply involved in blockchain initiatives for years, like with their private institutional platform called Quorum. It clearly shows the established financial world isn't waiting for perfect regulatory clarity. They're building the rails, the infrastructure, right now.
And a big driver of that institutional interest is this idea of tokenization.
Exactly. Tokenization is a huge potential application. It's the process of taking traditionally illiquid assets, things that are hard to buy and sell quickly, like a share in a large commercial building, a piece of fine art, or a stake in a private company, and representing ownership of those assets as digital tokens on a blockchain. The potential here is massive. It could democratize access to investments that were previously only available to the ultra-wealthy or large institutions. It could make these high-value assets much more liquid, easier to trade, and accessible to a far broader range of investors globally. That's a powerful incentive for Wall Street.
Okay. We have covered a lot of ground. We've seen the pressures on the dollar, the promise and perils of crypto, the regulatory mess. So we've reached the point where we need to bring it all together. What does this actually mean for you, the person listening, trying to manage your own money, plan for the future? It feels like you're almost forced to choose between two systems, right? Each has unique benefits, but each also carries potentially catastrophic risks. On one hand, the US dollar, it still offers stability, global acceptance, that convenience factor, but it faces this undeniable systemic risk from the massive long-term debt and the policy uncertainty we discussed. On the other hand, crypto. It offers this potential for huge returns for a hedge against the traditional system, but it's absolutely plagued by extreme execution, risk of the volatility, the security failures, the hacks, the scams, and this constantly shifting, uncertain regulatory environment.
That's the core dilemma. And sophisticated analysis, really, it boils down to you deciding which of those two fundamental risks, systemic risk in the dollar system or execution risk in the crypto system, feels greater to you based on your own situation, your timeline, your risk tolerance. For evaluating crypto exposure specifically, the analysis needs to bridge the gap between traditional finance and this new digital world. We talked about the research confirming that Bitcoin's returns do seem formally linked to things like gold and interest rates, particularly reacting to those unexpected inflation shocks.
Right. So the practical takeaway there, the action item for your playbook, is that you can't just look at Bitcoin charts in isolation. You have to pay attention to key traditional economic indicators. You need to track those inflation reports, the CPI, Consumer Price Index, the PCE, Personal Consumption Expenditures Index, that the Federal Reserve watches closely. Because surprises in those reports, signs of unexpected inflationary pressure, have historically been a key trigger for Bitcoin, potentially acting as that hedge against fiat currency losing value.
Exactly. Investors really have to make a directional bet here, consciously or unconsciously. If you fundamentally believe the U.S. government won't get its fiscal house in order, that the debt trajectory leads inevitably towards some kind of crisis, or if you believe geopolitical tensions will escalate, leading to more unilateral sanctions that further destabilize the dollar's global role, well, that belief structure naturally favors the bull case for holding some decentralized non-sovereign assets like Bitcoin. That's placing your bet against systemic risk.
Okay. And the flip side.
The flip side is the execution risk bet. If you look at the history of crypto, the chaos, the exchange collapses blowing up, the endless scams, the sophisticated technical vulnerabilities we detailed, and you think this is likely to continue, or maybe worse. Or if you believe that the sheer power of regulators, like the SEC's current posture, or the seize and freeze capabilities built into things like the Genius Act for stablecoins, will ultimately constrain or even crush the truly decentralized aspects of digital assets, then that belief structure favors the bear case. It favors sticking with centralized, regulated assets, or perhaps just holding traditional fiat currency.
So it really comes down to which potential failure mode worries you more.
In many ways, yes. But regardless of which way you lean on that bigger market question, some practical defense measures are just non-negotiable, especially if you do decide to hold digital assets. We touched on hardware wallets earlier. If you use a hardware wallet, and you probably should for significant amounts, you have to internalize that the security ultimately begins and ends with you, the user. The technology helps, but user error is the biggest risk. The absolute primary defense against some of the most effective phishing scams involves using that physical device correctly.
What specifically do you mean?
You must physically verify the critical transaction details, double-check the recipient's address, check the exact amount being sent, confirm the specific crypto asset you're sending on the screen of the hardware wallet device itself before you press the button to approve or sign the transaction. Why is this so critical? Because malware on your computer can easily trick the display on your computer screen. It can show you one address while secretly substituting the scammer's address in the actual transaction data being sent to the wallet. But the scammer cannot tamper with the isolated secure screen on the hardware wallet itself. That physical screen shows the true details of the transaction the device is about to sign. Verifying on that device screen is your crucial last line of defense against getting tricked.
That's a really vital point. Trust the device screen, not necessarily your computer screen.
Precisely. Now, stepping back again to the dollar, why is it still so dominant despite all these debt numbers we've talked about? Well, experts from places like the American Enterprise Institute, AEI, or the Official Monetary and Financial Institutions Forum, OMFI, they argue the dollar's long-term strength still relies on the U.S. maintaining global trust. And that means pursuing reasonably sound macroeconomic policies, but also, critically, avoiding the temptation to unilaterally overuse sanctions in ways that drive other major countries to actively seek alternatives.
But maybe there's an even deeper reason for its persistence, something more structural.
There likely is. Perhaps the most profound factor now is purely financial. The dollar's dominance seems increasingly driven less by trade dynamics and more by this massive structural global demand from investors for safe dollar assets, primarily U.S. Treasury bonds, but other high-quality dollar debt too. This overwhelming global demand for safety and liquidity creates what economists call the convenience yield. It's like a hidden benefit you get from holding the world's safest, most easily tradable asset. And this convenience yield helps keep the dollar strong, perhaps even overvalued relative to trade flows, despite the large trade deficits the U.S. consistently runs. Investors worldwide just need a safe place to park trillions of dollars. So we've laid out the evidence. It seems clear the world is actively looking for alternatives, or at least hedges, to the current dollar-centric system. The consensus view seems to point towards a more multipolar currency world emerging. And significantly, a notable portion of financial professionals already see a digital currency as a plausible candidate to displace at least some of the dollar's functions.
And furthermore, the way regulation is developing, especially with things like the Genius Act clamping down on stablecoins, it suggests the most likely near-term future might not be a simple choice between USD or crypto. It might actually be a fusion. USD-backed crypto. Digital dollars, essentially.
Yeah.
Tightly integrated into the existing financial system, highly liquid, yes, but also heavily regulated and subject to government oversight. The whole decentralized versus centralized battle might be morphing into more of a regulated hybrid system.
Which brings us to one final, really profound challenge, something that goes beyond even the current economic models and regulatory fights. It's about the underlying security. The cryptographic algorithms that protect Bitcoin, Ethereum, almost every major blockchain today, predominantly rely on something called elliptic curve cryptography, or ECC. The issue is ECC is known to be theoretically vulnerable to a specific type of attack using something called Shor's algorithm if someone ever manages to build a large-scale, reliable quantum computer.
Quantum computers, yeah, that still feels a bit sci-fi, but the threat is real.
The threat is taken very seriously by cryptographers and national security agencies. In response, standards bodies like NIST in the US are already deep into the process of selecting and standardizing new cryptographic algorithms that are believed to be resistant to attack by quantum computers. These are called post-quantum cryptography schemes. You might hear names like Kyber, dilithium, Falcon Argonili. These are based on different mathematical problems, like lattice-based cryptography, that quantum computers aren't expected to solve easily. The race is already on to figure out how to transition our global digital infrastructure to these new quantum-resistant standards.
So we have this race to upgrade the cryptography before quantum computers become powerful enough.
Exactly. Which leads us to the final provocation for you, the listener. The question that really ties together the entire future of money, technology, and national power. It's this. Will quantum computing advance fast enough to break Bitcoin's current encryption before the US dollar's trajectory breaks its own debt ceiling? Think about that. It's a stark race. A potential cryptographic failure on one side versus a potential macroeconomic collapse on the other. And the outcome of that race could fundamentally define the global economy for the next 100 years.
Wow. That is definitely something to chew on. A race between quantum code breaking and national bankruptcy. We genuinely want to hear what you think about that ultimate challenge. What's your perspective? Do you worry more about the quantum threat, more about the debt ceiling? How does this fit into your personal HODL versus sell strategy? Please pause this deep dive for a moment. Go down to the comments right now. Share your thoughts, share your feelings, share your story. We really want to hear from you. We are KaiZen, and we want to thank you for diving deep with us today.